So if you're out there raising funds from, private investors for your deals, one of the things you might have noticed is I think there's been a shift in appetite from these investors over the last 6 to 9 months in terms of the kinds of deals that they want to invest. Traditionally, before the interest rate hike period and everything like that, used to raise a lot of funds in traditional equity type of manners, right? Where investors would get ownership and kind of take the long-term potential of a lot of the plays that we were making. But I've noticed a recent shift that now they're actually not as excited about that and are looking for something else. So what I thought I would do in this video is talk about the shift and how it's potentially making me think about my deal structuring moving forward in 2024. So we're gonna get after it right now. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes of the video, 2 super quick things, guys. Number 1, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I put out weekly content talking all different facets of multifamily and real estate investing, from construction to acquisitions to financing to lending. I give you guys tours of my projects. So if that's the kind of content you're looking for, make sure you subscribe. So with that, now let's actually get into the meat and potatoes of the video. And as I said, I think, if you're someone that's raised funds or are raising funds, or if you're someone that, is looking to invest passively, right? I think that there's been a shift in what people are looking for. So as I kind of said in the intro, right? In years past, what I've done is I've taken value add deals, right? And, if you guys don't know, I operate in the Boston market. So I'm dealing typically with, higher priced real estate, typically with lower yields anyway. And, we would kind of play a longer term game by buying quality assets in great locations, right? And I think it's still a great thesis. But one of the things I noticed recently is, with a new interest rate environment, with the kind of volatility that we've started to kind of see a little bit in the marketplace, investors, they're less excited about making these kind of long-term opportunistic kind of plays, right? And I kind of saw that on a recent project that I've been working on, right? I have a apartment building that has a lot of construction involved, and a lot of the investors, though they were really excited about the location, just didn't really have that appetite to take that that risk and that long-term view about, this will be a great building to own in 5 to 7 years, which is very different from years past. Whereas on another example, right, I was actually raising funds for a different project, which is a development project. And on my development projects, I typically, the deal structure that I typically offer is a flat annualized rate of return for investors, right? So, typically anywhere from 12 to 15% annualized, where investors don't get any they don't get any ownership or upside in the deal, but they get that for certain, they get that return. That kind of investment opportunity, from what I've seen, has never been more popular, right? Like now when I talk to folks or email folks about that kind of opportunity, I see people jumping at the chance to make that 12, 14, 15% kind of yield. And I think it says a lot about the marketplace, right? Because again, basically in this kind of structure, investors are not taking, these individuals are not taking any downside risk on the project, right? Especially when there's heavy construction involved. A lot of them, if they're not in the front lines, don't necessarily want that risk, which I totally understand. And B, having that high yield is great, especially in this high interest rate environment, right? Because a lot of investors, the way they actually get funds to invest in these deals is, they might take out cash from home equity lines of credit, and obviously the interest rates on those have gone up. They might be taking out cash, which is sitting in bank accounts, but obviously a lot of savings account over the last year, have increased their rate of return. So, offering that even higher yield has been really, really important to get people excited about to invest in the project. So what does this actually mean, right? So we can kind of see that, a lot of more retail investors, and again, a lot of my investors tend to be smaller mom and pop individuals, right? You can kind of see that, they are looking for something consistent. They want something that's producing cash for them day one, as opposed to that long-term kind of upside play. So what that tells me is, look, I mean, at the end of the day, there is still demand to use real estate as a vehicle of investment, right? To be able to generate returns. People still get that. They still understand the fundamentals. I think they're just more than ever they want less risk exposure, right? Which makes total sense. Again, given the interest rate environment, given the volatility we've seen in the economy, they might be thinking, I want something a little bit more consistent, a little bit more guaranteed, something that produces cash flow right away, and I don't have to wait a year or 2 years into the unknown to see what kind of upside there might be on the play. So, if you're someone that's structuring deals and you've seen the same thing, right, you might just want to think about different ways of structuring and, raising your funds to make sure that you're kind of achieving this new kind of vision that a lot of investors have, right? So, you might be, instead of traditional equity, you might want to talk about these kinds of different structures, which again, give you the benefit of meeting the need in the marketplace as well as still putting deals together. But at the end of the day, as I said, right, I still think quality assets and quality markets, there's still going to be an appetite. People are still going to write checks for. And you know what? If you're dealing with family office or high net worth or, even institutional, it might be completely different. I don't know. I don't work in that space as much, but that's just more from what I see on the small investor base. So hopefully that's helpful for you guys. If you guys have been seeing the same thing, or if you've been seeing the total opposite, make sure you put the comments below, and I would definitely be interested to see what you guys are seeing out there, and otherwise happy to help out.